Hello students, I am Girish Kumar. I welcome you in this session of macroeconomics. Today we will be going to discuss about value added method of measurement of national income. Before starting the topic measurement of national income by value added method, we need to recall meaning of national income. In our previous session, we had discussed about national income and domestic income. So, what is national income? National income is the income which is earned by the normal resident of the country, irrespective of whether earned in the domestic territory or rest of the world. And domestic income is the income which is earned within the domestic territory of a country, irrespective of whether earned by normal residents or non-resident of the country. In previous session, we had also discussed about circular flow of income. There are three different phases of circular flow of income, namely generation of income, distribution of income and disposition of income. In other words, we can say that production generation income, with this income household purchase goods and services for final consumption and investment. In this way, income creates expenditure. So, income is generated, distributed and spent. This makes the circular flow of production, income and expenditure complete as shown in this figure. In fact, methods of measurement of national income originate from these three different phases of circular flow of income. So, we can measure national income by three methods: value added method, income method and expenditure method. In the first phase of production of goods and services, we can measure the national income by using production method or value added method. In the next phase of generation of income, we can measure the national income by using income method, and in the last phase of disposition of income, we can measure the national income by using expenditure method. Since all three methods are only different viewpoints of the same flow of goods and services, national income from each method should be equal to each other. So, use of a particular method depends on the availability of reliable data. So, in this session, we will understand first method of measurement of national income, production method or value added method. In this method, we calculate aggregate annual value of goods and services produced during a year by all production units in the economy. The term that is used to denote the net contribution made by a firm is called its value added, and we can define value added as the addition of the value to the raw material by a firm during the production process. It is calculated as the difference between value of output and value of intermediate consumption. Here, it is also important to understand the meaning of value of output. Value of output is the market value of goods and services produced by a firm during an accounting year. Value of output can be calculated by multiplying the quantity of output with its market price. Hence, gross value added at market price is equals to value of output minus intermediate consumption. Net value added at factor cost NVA at FC is derived by subtracting depreciation and net indirect taxes from gross value added at market price. So, the formula to calculate net value added will be NVA at FC is equals to gross value of output minus intermediate consumption minus depreciation minus indirect taxes. When value addition made by each and every firm is summed up, we get the value of national income. We can study value added method under three subheadings: methods, steps involved and precautions. Now, let us start with the methods of measurement of national income with the help of value added or production method. While using this method, domestic income is first calculated by adding the value added by all producers during an accounting year within the domestic territory of a country. This total is called net domestic product at factor cost NDPFC, which is also known as domestic income. Then by adding net factor income from abroad NFIA to domestic income, we get national income NNPFC. So, national income is equals to domestic income plus NFIA. Students, now we will discuss the steps involved for calculation of national income by product method or value added method. Step 1: identification of all the production units in the domestic economy and classify them into three industrial sectors such as primary, secondary and tertiary sector. Step 2: calculation of value of output produced by each firm in all sectors of the economy during the year. Value of output is equals to sales plus change in stock. Step 3: calculation of value added and GDP at MP. It is the difference between value of output and intermediate consumption. So, GDP at MP is equals to value of output of all the firms in the economy minus intermediate cost. Step 4: calculation of net domestic product at factor cost NDPFC. If we make adjustment of depreciation, indirect taxes and subsidies in GDP MP, we get net domestic product at factor cost NDPFC. So, NDPFC is equal to GDP MP minus depreciation minus NIT. Here NIT means indirect taxes given to the government minus subsidies received by the government. Step 5: calculation of national income at factor cost NNPFC or national income. As we know that net national product is the sum of domestic income and net factor income from abroad. National income NNPFC is equals to domestic income NDPFC plus NFIA. So, by following these steps, we can find the value of domestic income as well as national income. Dear students, now we are taking two illustrations to understand how national income can be calculated with the help of value added method. Illustration 1: suppose in a hypothetical economy, there are only two firms A and B. Firm A sold goods for rupees 200 crores to firm B and imports goods for rupees 100 crores. Firm B exported goods for rupees 150 crores and had domestic sale of rupees 250 crores. Calculate net domestic product at market price if consumption of fixed capital depreciation is rupees 20 crores. We can calculate the value addition made by firms by using the formula we have learnt in today's session. We may prepare a table as well. In this table, we have the columns firms value of outputs, intermediate consumptions, value additions, all in crores. In this table, you can see that firm A sells to firm B for rupees 200. This is the value of output of firm A, and firm A imports rupees 100 crores. So, it is the intermediate consumption of firm A, and the difference between value of output and intermediate consumption is value added. So, the value added of firm A is 100 crore rupees. For firm B, domestic sales by firm B is 250 crores and purchase from firm A is 200, and at the same time firm B also exports 150 crores rupees goods. So, total value of output of firm B is 400 and its intermediate consumption is 200. So, the difference is value added, that is 200. Students, in this question it is given that there are only two firms in this hypothetical economy. So, domestic product is the summation of value added by these two firms only. Hence, gross domestic product at market price will be the summation of value added made by firm A 100 crores and value added by firm B 200 crores, total 300 crores. For calculating net value of domestic product, we need subtract depreciation from this. So, the formula will be net domestic product at MP is equals to gross domestic product at MP minus consumption of fixed capital, rupees 300 crore minus rupees 20 crore is equal to rupees 280 crores. Now, take another illustration. From the following data, calculate gross domestic product at market price, GDP-MP, domestic income, NDP-FC, national income, NNP-FC. In this question, we have given different information related to the different sectors of an economy, which are required for the measurement of national income by value added method, such as value of output, primary sector, secondary sector, tertiary sectors, intermediate consumption, primary sector, secondary sector, tertiary sector, indirect taxes paid by all sectors, subsidies received by all sectors, consumption of fixed capital of all sectors, that is also depreciation, net factor income from abroad. So, let us come to the solution. GDP-MP is equals to value of output of primary sector, secondary sector, tertiary sector minus intermediate consumption of all these three sectors, primary sectors, secondary sectors and tertiary sectors. So, GDP-MP will be equals to 8,000 plus 6,000 plus 10,000 minus 3,000 plus 2,000 plus 4,000. So, total 24,000 minus intermediate consumption of all three sectors 9,000. So, GDP-MP will be 15,000 crore rupees. Second, domestic income NDP-FC is equals to GDP-MP minus net indirect taxes minus depreciation. So, the values are 15,000 minus 1,000 minus 200, that is 800, it is NIT, and minus 700, that is depreciation. So, the domestic income is equals to 13,500 crore rupees. Third, national income is equals to domestic income plus NFIA. In this question, the value of NFIA is negative. It means in the economy, factor income received from abroad is less than the factor income paid to abroad. Then national income is equals to 13,500 plus minus 500. So, the value will be 13,500 minus 500. So, national income is equals to 13,000 crores. Students, national income is a broader concept than domestic income, but here you can see that domestic income is more than the national income because of the negative value of NFIA. Precautions. Students, we have to keep in mind some precautions while estimating national income by value added methods. These are: avoid double counting. The problem of double counting arises when the value of same goods and services are counted more than once while estimating national income. For example, cotton produced by farmer, then with the help of this cotton, thread mill produced threads, and then cloth mill produced clothes. So, actually in the value of clothes, the value of cotton and thread is also included. This creates problem of double counting. To avoid double counting, we have two approaches. Either we have to take the value of final goods and services only, ignoring all intermediate products, or we have to take value added at different stages in production process instead of total output. Precautions 2. Imputed value of production for self consumption must be included. For example, farmer consuming its own production, it must be including while estimating national income, because output produced but retained for self consumption rather than selling in the market, but actual production take place. So, this value must be included in the national income. Third, do not include sale of second hand goods because they are not fresh production activities. They are not a part of current year production. Moreover, their values had already been included in the national income of the year in which they were produced. Recapitulations. Dear students, in today's sessions, we have discussed value added method for estimation of national income. So, this is the time for revision. There are three methods of measurement of national income: value added method, income method, and expenditure method. Second, the difference between value of output and value of intermediate consumption is known as value added. Third, NVA at FC is equals to gross value of output minus intermediate consumption minus depreciation minus net indirect taxes. Fourth, precautions while estimating national income by value added methods are: avoid double counting, imputed value of production for self consumption must be included, do not include sale of second hand goods. Assignments. First, define concepts of value added. Second, what is meant by problem of double counting. Third, which of the following items will be included while estimating national income? Give reason. Purchase of second hand machinery from abroad, milk purchased by sweet maker, wheat grown by a farmer but used entirely for his family consumption. So, in next part of this chapter, we will discuss about income method of measuring national income. Keep exploring till we meet again. Thank you.